China wants to open its economy to the world. One way to do this is to widen market access to foreign investors. At the annual Boao Economic Forum in China, President Xi Jinping promised to implement new reforms to achieve that goal. Apart from lower tariffs on products such as cars, the government says it will also revamp its financial sector.
First, foreign equity restrictions on banks and financial asset management firms will be cancelled, with equal treatment for domestic and foreign-funded institutions. Foreign banks will be allowed to set up branches and subsidiaries at the same time in the country. Second, foreign businesses will be allowed to own up to 51% of shares in securities, funds, futures, and life insurance joint ventures, and the cap will be phased out over 3 years. Third, securities joint ventures will not be required to have at least one securities firm among its domestic shareholders.
The measures will come into effect before the end of this year, as Beijing aims to fend off rising criticism that it unfairly limits competition. The announcements were made as China is in the middle of a trade dispute with the US, one that's turned into a bitter tit-for-tat tariff fight that could cost both sides billions of dollars. The head of the International Monetary Fund, Christine Lagarde, warned governments against undermining global growth with protectionist trade policies.
Governments need to steer clear of protectionism in all its forms. History shows us that import restrictions hurt everyone, especially the poorer consumers. Not only do they lead to more expensive products and more limited choices, but they also prevent trade from playing its essential role of boosting productivity and spreading new technologies.
Talks between the US and China reportedly broke down last week after President Donald Trump's administration demanded China reduce its support for high-tech industries. But there's still hope that both sides will agree to compromise and a trade war can be averted. Arabella Munro, TRT World.
Well, Patrick Falk has more on this from Hong Kong.
The sun is shining, but we need to fix the roof. That was the message from the IMF's managing director at Hong Kong University today, where she delivered the annual spring meeting curtain raiser. She was talking about the need to guard against fiscal and financial risks, in particular debt levels that have soared over the last 10 years following the global financial crisis because of easy money and stimulus. She did hint that the IMF's official growth outlook for 2018 and 2019, which will be delivered at the meeting itself next week, remain very much positive, pointing towards the health of the US and European economies. And she also said that Asia remains a bright spot, but there was caution over the medium term because of fading stimulus, interest rate rises, and tightening financial regulation. The focus of her speech today, though, very much echoed some of the comments made by Chinese President Xi Jinping at the Boao Forum in Hainan, and there was little doubt who she was referring to when she warned that governments must steer clear from protectionism and said the way to address macroeconomic trade imbalances was to use fiscal policy to boost economic productivity. She didn't let China off the hook completely, though. She did also say that countries, and this was no doubt directed at China, needed to address some of their own trade practices. These were, of course, things that the Chinese president addressed during his speech yesterday, but economies the world over will be looking very carefully to see whether there's follow-through on the many trade reforms he spoke of.
Well, Jasper Lawler joins us now from London. Jasper is a senior market analyst at London Capital Group. Thank you very much for talking to us, Jasper. So the global trading system then could be torn apart, according to Christine Lagarde. Do you share her concerns?
Well, I certainly share the concern that that could happen. It's not my default expectation that's what's going to happen, but it's certainly a risk. And so I think that's why you've seen a fair bit of turmoil in financial markets, a bit of an overreaction, some might say, but obviously investors are sort of looking a couple of steps down the road here, that if the US and China engage in a few tit-for-tat reactions, that can then spread to other countries, and so suddenly you go from quite a free and open trading system to one that is quite protectionist, and will lead to the kind of things that Mr. Lagarde was talking about there, the high prices and less spread of technology throughout companies, which have clearly been beneficial for global growth and for financial markets.
So why do you think this is happening now then, and that nations are slightly turning towards protectionism and away from the current globalized system?
Well, I think there's a few kinks in the system, basically. And so there are a few anomalies, if you like. And so they're most easy to see through the balance of trade. And so there are a couple of stark examples that Donald Trump has been pointing to, namely Europe and specifically Germany has a very large fiscal and current account surplus. So in a sense, they're taking in more money than they're spending on a fiscal stance, and at the same time in trade, Germany is exporting a lot more than it's importing, and the same can be said for China. And a lot of those, when they're getting that surplus, a lot of the time it's the US that's getting the mirrored deficit. So the US is obviously paying out more than it's getting back. And so Donald Trump has made this a top issue for him. And so the way he's going about it, I would disagree. It's probably not the right approach in terms of introducing tariffs, but he is highlighting some of the issues in this kind of global free trade system, that some countries have huge deficits, some have huge surpluses. And so it's not actually working perfectly, even as we stand.
The IMF also estimates that global public and private debt is at an all-time high right now. I mean, this isn't sustainable, is it? What is likely to happen next?
Well, obviously, we called it the global debt crisis when it was the financial crisis. A lot of it is because the high levels of debt during difficult economic times, you're obviously not able to pay back that debt, and that has a chain reaction throughout the economy. So I think what generally has been happening over the last few decades, if you like, is that debt has just been creeping higher and higher, but only during periods of financial disruption has it come to light and actually caused a problem. And so that's what we've seen since the financial crisis, is that it caused that big financial crisis, but then it continued in the same pattern. And now, probably down the road, the high debt pile is going to just make each subsequent financial crisis that much harder to deal with.
OK, Jasper, thank you very much. Jasper Lawler, thank you for talking to us.